Hey guys, welcome back to Father and Son Investing. The good news of the week for me is that the son is back. The son from Father and Son is back from being a missionary. You should get to see him in a video soon. That is good news for me. Now, today's video is going to be the Treasury Bill update for August 2023. There's been a number of important news items that have happened this week that are going to affect your Treasury Bill yields. So we're going to talk about those. Then we're going to talk about what Treasury Bills have been doing since these news items have come out. I'm going to give you my outlook for what I think is going to be the Treasury Bill to be buying right now. All of that and maybe a little more in just the next few minutes. So let's get to it. All right, the biggest announcement that has happened this week was, of course, the Fed meeting, the FOMC. They announced on Wednesday the 26th that the Fed funds rate will be going up. It will now be 5.25 to 5.5%. So that is an increase of 25 basis points. Now, after that was announced, of course, Chairman Powell does a little news conference, and I've read through the minutes from that news conference. It's actually pretty extensive there, but I kind of see these reporters as trying to get Chairman Powell, Jerome Powell, to say something that he didn't really plan on saying. They hassle him so much and keep asking the same kind of question over and over in different ways, and suddenly he spouts off something that he didn't really plan on saying. So having looked through here, first of all, I see the same mantra that they just keep saying, we're committed to keeping inflation at 2%. We're committed to getting inflation down to 2%. And the other mantra that comes out of there is, we're going to use the data, we're going to use the data, we're going to use the data. So I'm going to take you down to page 15 in the transcript for this news conference, where I think he might have let something slip that he didn't plan on. All right, I've highlighted it here in green. Now, as context for this, the questioner had been asking him about the summary of economic projections, which is something that they also released when they released the Fed meeting minutes. So this questioner had said something about, according to that summary of economic projections, it looks like when you guys get close to 3% or under 3%, you're going to start cutting rates. Is that the case? And, Chairman Powell started saying, well, of course, we're going to look at everything, and it's hard to tell. We don't even know what's going to happen next meeting cycle, let alone next year. So then the guy followed up with a question. He says, so if it's sort of stubbornly, maybe in the high twos, you wouldn't necessarily cut rates? And this is where I think he might have let something slip. I've highlighted it here in green. But he says, I'm not saying that at all. I'm not giving you any numerical values around that. Then he says, I'm saying we'd be comfortable cutting rates when we're comfortable cutting rates. And that won't be this year. I think that was a big statement in there that he might not have planned on releasing. And that won't be this year. I don't think, he says. I don't think it's going to be this year either, based on all the things I've been reading and hearing different statements from different members of that FOMC. Then he goes on and he says, it would be, many people wrote down rate cuts for next year. I think the median was several for next year. Then he says this, and that's just going to be a judgment that we'll have to make then, a full year from now. So I think that might have been another thing that he let slip that he didn't plan on. He's looking at potentially a year from now when they're really cutting rates. So what do I get out of this? That's going to inform me a little bit on which Treasury bills I'm interested in, which we'll get to at the end. All right, the next bit of data came out the following day on the 27th. That's when we got the U.S. economic growth numbers. And the big thing in there was that on an inflation-adjusted basis, GDP grew at 2.4%. That was actually more than expected, which was saying that the economy is still running pretty well. There were some other numbers in there that could also affect how things were going for your Treasury bills. It talked about consumer spending. It said consumer spending was down, although the PCE numbers that I'm going to talk about here in a minute didn't necessarily agree with that. I want to take you to a chart here in the Wall Street Journal before we move on to those PCE numbers. You'll see here in pink the actual GDP numbers. Of course, this is the one that was just released for the second quarter, 2.4%. And then here in gray, you're going to see the forecast for GDP. So third quarter, they're saying 0.59% growth. Looking in the first quarter of next year, we're looking at negative GDP before it starts to rebound rather timidly. So keep that in mind when we're talking about Treasury bill yields here in a little bit as well. All right, this is the headline in CNBC for today. Key Fed inflation rate falls to lowest annual level in nearly 2 years. This one to me is like kissing your sister. You know, it sounds really good. It's the lowest in 2 years. If we dig into the numbers, we'll see that the headline inflation, that essentially just means inflation with food and energy costs in there, was at 3%. That sounds really good. The problem is that core inflation, what the Fed is really paying close attention to when they talk about getting down to 2%, that came in at 4.1%, which is more than double what they're looking for. Now, granted, it's better than the 9% that it was last year, but 4% still double. So this one is like kissing your sister. There are some other numbers that came out in this report as well. The Commerce Department said that personal income rose 0.3%. All right, we're all getting a little more money, and spending has increased 0.5%. So when we're looking at inflation, of course, if people are spending more money, that's going to drive up demand. Now, that other report, the GDP data, talked about consumers decreasing how much they're spending. Yeah, they're still willing to spend, but they're also kind of looking for bargains out there. So those two reports are a little bit in conflict, maybe. And then lastly, just one more bit of data here, and that is the employment costs index. On a seasonally adjusted basis, that was up 1% during the second quarter. So that was slightly below the 1.1% estimate, but still increased 1%. All right, having looked at all that data, let's just take a quick peek at what Treasury bill auctions results have been doing the last 2 months, and then I want to show you another graph that's kind of interesting to look at in terms of the daily rate, daily yields on Treasury bills. So this particular graph is going to show you the auction results for Thursday's auction. That was yesterday. Those Treasury bills will be issued on August 1st, and we'll see that there isn't really much difference. It went up just a little bit here, but not much difference, which is a little bit surprising maybe to you if you're thinking, wait a minute, there was a 25 basis point hike. Why didn't these Treasury bills go up by 25 basis points? And here's what I want to show you. So this is a graph that I've made from the U.S. Treasury daily Treasury bill rates. I'll take you to that webpage here in a minute because I'll show you how you can subscribe to that data if you'd like to just get it in your email box each day that it's available. But looking at this data, what we're going to see actually is that that 25 basis point hike was actually kind of priced in before Chairman Powell made that announcement. I think everybody expected that they would be raising 25 basis points. I certainly did. So looking at the graph, we just see that there's this steep uptick in the yield on the 4-week Treasury bill, and there actually is an uptick on each of these Treasury bills here before that announcement came out on the 26th, and then they just mostly stay flat. The 26-week Treasury bill was actually still going up, even leading into that announcement before it came down a little bit. Now, what else happened here? Well, when the GDP numbers came in, we see that there was another uptick in the daily rate. When the PCE numbers came in today, there's actually a decrease now in the Treasury bill yields. So just know that news is going to affect these things sometimes daily. Even this week, the 26th, 27th, and 28th, we've had different news events happening affecting Treasury bill yields. But do I expect Treasury bill yields to be going up? This is what I really want you to get out of this video is the 25 basis point hike has already been priced in. So I don't think we're going to see big movement in these Treasury bill yields over the next 2 months, really, until September when the next Fed meeting comes in, unless there is some economic data in August that starts saying that inflation isn't under as good a control as we might think it is. It's still, remember, more than double what the Fed is looking for, that 2%. And Chairman Powell was adamant they are committed to getting it down to 2%. And every time we see some data looking like, hey, the economy's still growing, or the unemployment numbers are holding steady, or anything else that says the economy is still doing well, having read through those minutes, I think the FOMC is looking at that data, not just the inflation data. So which Treasury bill do I think looks really good right now? The 26-week Treasury bill actually looks really good to me. According to that statement that Chairman Powell sort of leaked out, in my opinion, he said we're not lowering rates this year, I think. I think that his "I think" may be a little bit more than just him thinking it, that maybe other members of that committee are thinking that as well. Now, I want to point out something a little bit wonky to you here. I'm going to take you to the Fed's actual page, and we'll just look at something weird between the 26-week and the 52-week Treasury bill. And what does that say? Now, I want to show you that little wonky thing that I was talking about. It's going to be between the 26-week Treasury bill and the 52-week Treasury bill. Now, in theory, the 52-week Treasury bill should give you a higher yield. If you're going to loan the government money for a longer period of time, you should get a better rate of return. However, that is not the case. It's going on with every Treasury bill leading up to the 26-week one, and then this is what happens between 26 weeks and 52 weeks. So we're going to look at this coupon equivalent. That's essentially the high yield if you're looking on the Treasury Direct website, and we'll see that it says 5.51. Now let's turn over to the 52-week Treasury bill, and when we look at the coupon equivalent, it's 5.38, significantly less than what the 26-week Treasury bill is yielding. What does that say? To me, it says that the public and these big banks and corporations that are buying Treasury bills think that yields will be going down before, sometime after the 26-week Treasury bill matures, and really before that 52-week Treasury bill matures, going down enough that they're willing to take a little bit less yield on a 52-week Treasury bill because they're thinking that in the future, the 52-week Treasury bill will be offering even less. So that's really the part up for debate because, again, I showed you that part I highlighted in green from Chairman Powell, where he starts talking about a couple of rate cuts next year and where he says this time next year. So which Treasury bill do I like right now? Again, I like the 26-week one, but actually I like any of them right now. They are all putting out fantastic yields right now. There's a phrase I love that says, bears make money and bulls make money and pigs get slaughtered. And in this case, I think don't be a pig. You know, there's really probably just one more rate hike, if at all, this year. So you're not going to be able to squeeze that much more yield out of your Treasury bills. And there's a chance that that rate hike never happens, or they start cutting rates, in which case you're going to miss out on some fantastic yields. We haven't seen yields like this in years, decades. So keep that in mind. That's all I have for you today. Please share this information with other Treasury bill purchasers and with young people in your life. Get those little kids buying Treasury bills. Buy them for them. You can gift them to them. Share this information with a young person in your life. And until next time, enjoy your investing.